Hi, welcome to Strike. In this video, we'll be explaining to you market breadth indicators. What is market breadth? Market breadth is a measure of the number of stocks that are advancing versus the number of stocks that are declining. There are also different ways you can look at breadth like 52-week highs, 52-week lows, but looking at the advanced decline ratio is one of the easiest and common ways to spot medium term and longer term market cycles. So we've plotted two types of market breadth and one summation index. Let me explain these to you. The first is the 20-day advanced decline ratio. What we do here is we divide the total advances for the day, the number of stocks that are going up, by the total number of declines for the day, that is the number of stocks going down, and then take a moving average of that data. The reason we take a moving average is that the raw data may be slightly erratic and we want to actually study the underlying trend of the breadth over a period of time. So the 20-day ratio is good for shorter term cycles that last for a couple of weeks. And what you're looking at on the chart is the green indicator at the bottom, which is showing you the 20-day AD ratio. We've also plotted two red lines which show the general overbought and oversold zones where we've seen previous highs and lows. We do adjust these levels based on any change that may happen, but this has worked for a good period of time. I'm slightly zooming out so you can actually see how the 20-day AD ratio has performed historically. So you'll find that many bottoms in the market occur when the AD ratio comes to the bottom end of the range near the lower red line, or sometimes even goes below that. And similarly, many tops occur when the AD ratio goes above the red line or reaches the red line. What you also have to take note is that the AD ratios work very well, not just giving overbought and oversold conditions, but actually showing divergences. This is because when markets continue to advance, the number of stocks that are advancing with the market start to reduce. As markets continue to go higher, backed by fewer and fewer stocks, the AD ratio starts to diverge from the market itself, and thus we develop negative divergences. That helps us spot much more clearly an actual peaking or bottoming process in the market itself. So let us zoom in onto the data and actually see how this works on a couple of occasions. Like you're looking at the top here that occurred in 2018 and then subsequent bottoms and tops. At this top, you'll find that the AD ratio had already started to decline. It peaked over here on the 20th of August. The market still rallied to a new high but was not confirmed by the AD ratio. That becomes a clearer signal that a trend reversal is coming. You can find the same thing even at times near the bottoms. So you find markets are falling. The AD ratio is oversold, well below the red line, and then it starts to move up. This happens even as we enter this last leg of the decline on the market on the way down. So when this last decline takes place, the green ratio starts to rise. This is a positive divergence showing that we are in the last leg of the decline. So we can use advanced decline ratios to spot not just the oversold, overbought conditions, but actual reversals based on divergences that are common. The next we will move on to the 40-day advanced decline ratio. While this is based on the same data, the 40-day AD ratio gives us a slightly more wider perspective of the medium term to slightly longer term cycles. In fact, many major tops and bottoms occur when the AD ratio on a 40-day basis has gone to a super extreme. So we'll again take a slightly longer period of time to be able to spot such occasions. Here we are looking at all the data from 2012, and in this data we are able to see some extreme reading which is in COVID. Prior to this also we do have some previous extremes that are this low. But in between the periods, we haven't seen any major sell-off going significantly below the red line. But even when prices do come to the red line, the readings are similar, that we are looking for a medium term or a longer term top. So you notice it's after this entire 1 year bearish phase in the market in 2015 to 2016 that the 40-day AD ratio actually went below the lower red line. The same thing again happened in many of the bottoms that have occurred between 2018 to 2020, ending with COVID. And again, here, 2022 June, when the Nifty fell to 15,200, this bottom coincided with a decline in the 40-day AD ratio well below this lower red line. Same is also true at tops. You'll find that many tops occur along with the peaking of the 40-day AD ratio. But as explained in the 20-day AD ratio case as well, you will have to spot divergences. So you'll find that markets continue to go higher while the 40-day AD ratio continues to drop, and then you get an actual correction. Now, if you're actually looking at the smaller cycles from here to here to here, then you'd actually prefer the 20-day AD ratio that we've already shown you. Where the 40-day is really useful, like I said, is in spotting major reversals. And so, like I said, major reversals occurring at the lower red line when a meaningful decline over several months has occurred. And similarly, when you end up at the top end of the range on the 40-day AD ratio, also you'll find that markets can continue to advance with divergences, and that eventually results in a further decline. So here, when the Nifty went from say around 18,000 to 18,800, making a new high, the 40-day AD ratio did not confirm that new high, showing a significant divergence from price, and eventually the markets also rolled over and continued to decline with the ratio itself. Last but not the least, I've plotted something known as the AD summation index. Anyone who's read a book on advanced decline ratios would have some idea of what the summation is. One of the most basic ratios that is taught is to take the difference between the total number of advances and the total number of declines and then add it on a daily basis, creating a summed up number, and then plot that summed up number. This is known as an advanced decline summation index. So we're adding up the difference between the advances and declines on a daily basis into a cumulative number and plotting it as an indicator. Now, in the case of the Indian index, we have seen that this indicator appears to be declining for a large period of time. So how do we really analyze this data? The way to really analyze this data is look for periods where you see strength, and then look for a break to lower lows. These are two separate readings. One is when the market is very strong, like it is here, you will find that the AD summation index is also going up with the market. Now, at some point of time, it starts to fall. Now, even though it starts to fall, markets can continue to advance for a long period of time, and therefore, you can't simply look at one divergence and conclude that the market is weakening. The most significant declines, however, end up occurring when the summation index breaks the previous low. So if we actually end up with a situation where the advanced decline summation index actually broke, like I'm drawing it here, okay, when this previous low made in January was broken at this point of time, that's when markets start to decline. So they've actually been peaking over here, and breaking of the previous low is a signal that we are now starting the decline phase. This can be done at any point of time. For example, you can take the COVID low and see when did we really break the COVID low in the index, and that's somewhere here when we are in the final stages of this decline. Now, of course, in this situation, you might find that it didn't happen here. You can even take a previous swing low, for example, when this breaks, and take that as an indicator that we are beginning to decline in the markets. Now, for example, you had a rally from this bottom to this top, and when this rally was going on, okay, the AD summation index did go up, but eventually it started to break this low. When did it break this low? Just after the December top over here. So this is how it can be used, the summation data, more to confirm that a topping process has actually happened. Otherwise, you'll find historically at certain points of time, the ratio simply continues to drop like it did here and doesn't really tell you anything, because here the market's going up, the ratio is sort of declining throughout this phase, and you can't really trade this signal because the actual sell-off in the market only occurred much later. So that's how you actually use AD ratios. The most useful are the 20-day and 40-day for shorter term and medium term cycles. The AD summation index helps in adding an additional flavor to the peaking process as and when we see the indicator breakdown. At the same time, it can advance with a very strong market as we saw over here, and that also allows you to stay with the trend on the upside till you actually start making lower lows and lower highs.